Hey, to whoever may need this nugget of encouragement, things will be alright, so quit your worrying. I get it, the odds seem stacked back against the wall, but even consider it such, know you'll stand tall. Sat and watch from the sidelines, one too many times. Wicked games we play make me wanna lose my mind. Found solitude, knowing it'll be over soon. Ever need a boost, count on me.
Have you ever looked at your checking account on the first of the month?
Right, as that housing payment just disappears.
Exactly. And you find yourself stuck in that classic perennial debate. On one hand, you've got this nagging feeling that renting is just, well, that it's lighting cash on fire.
Oh, absolutely. But then you look at current housing valuations.
Right, valuations, or the sheer cost of capital right now, and you think, buying a house is a complete trap. I have liquidity, zero maintenance liabilities, and I am perfectly fine right where I am.
It is a debate that almost everyone who cares about their financial trajectory wrestles with. And what's interesting is how quickly the conversation becomes polarizing. I mean, people really dig their heels into one camp or the other.
They really do.
Yeah, and they usually rely on outdated heuristics, or maybe a single bad experience with a contractor, or just general market anxiety rather than running the actual mechanics of the numbers.
Which is exactly our mission for today's deep dive. We are going to completely deconstruct the financial realities and those underlying psychological barriers of renting versus owning.
It's such a crucial topic.
It is, and we're basing today's analysis on a highly detailed breakdown provided by Elite Credit Group. What makes this specific source material stand out is that it completely strips away the usual guilt trips.
Right, no judgment.
Exactly. It doesn't tell you you're a failure for renting. Instead, it systematically maps out the math, the mechanics of leverage, and the hidden credit roadblocks that keep people trapped in a holding pattern they might actually want to exit. So, okay, let's unpack this.
To set the overarching theme right from the start, this analysis is absolutely not about shaming anyone's housing choice. It's about recognizing the structural difference between paying a premium for convenience and liquidity today versus engineering a mechanism for long-term capital accumulation.
It's a mindset shift.
Totally. It requires a fundamental shift in how you evaluate the capital you're required to deploy just to keep a roof over your head.
And to be fair to the renting camp here, the source material actually leads by aggressively defending the utility of renting. Renting is not inherently a sign of financial mismanagement.
Not at all.
It offers immense, sometimes completely necessary flexibility. Like if you are in a season of life where your human capital is highly mobile, tying yourself to an illiquid asset doesn't make strategic sense.
Exactly. The financial benefits of renting are highly tangible. First off, you have drastically lower capital requirements up front. You aren't, liquidating investments or draining cash reserves for a down payment or closing costs.
You just park a security deposit and you have immediate utility of the property.
Right. Second, and this is the big one for risk-averse individuals, you have zero liability for systemic property failures.
Ah, yes. The classic water heater blowing up at 2 a.m. scenario.
Exactly that scenario.
But it's even bigger than that. If the foundation cracks or the roof needs a total replacement, that is a massive capital expenditure that you simply do not have to absorb.
It's the ultimate risk transfer. When you rent, your monthly payment is the absolute maximum you will pay for housing that month. When you own, your mortgage payment is the absolute minimum you will pay.
That is such a great way to frame it. Maximum versus minimum.
And thirdly, renting provides predictable short-term cash flow requirements. For the duration of your lease, your housing expense is completely insulated from sudden property tax assessments or spikes in insurance premiums.
So the analysis points out that if you are highly mobile, actively relocating to maximize your career earnings, or if you're deliberately taking a year or two to rehabilitate your financial profile, renting is the mathematically correct choice.
What's fascinating here is where that utility hits a brick wall. Renting is a phenomenal short-term hedge against volatility and immobility, but its fundamental limitation is that it is purely a consumption expense.
It just solves the immediate need for shelter.
Exactly. It completely fails to act as a wealth-generating vehicle. You are purchasing a service, not an asset.
And that brings us to the math, or what we can call the $300,000 blind spot. The breakdown highlights a really stark reality about the single-function nature of rent.
Single function is the key phrase there.
Right. When you pay a landlord, that capital serves one purpose, securing 30 days of occupancy. Once the month is over, the value of that capital is entirely exhausted.
Contrast that with the dual-function nature of an amortizing mortgage. When you deploy capital into a mortgage payment, yes, a portion is consumed by interest and taxes.
Cost of capital and the cost of the service.
Exactly. But the principal portion is essentially a forced transfer from your checking account to your personal balance sheet. You are shifting capital from a liquid form to an illiquid form, but you retain ownership of it.
The numbers they run to illustrate the opportunity cost here are pretty sobering. Let's look at a baseline rent of $2,500 a month. In 1 year, that's $30,000.
Darn.
Yep. In 5 years, $150,000. Over 10 years, you've deployed $300,000 of capital.
And at the end of that decade, your equity position derived from that $300,000 is precisely zero.
Now, let me play the skeptic here for a second, because any savvy listener is going to immediately point out the unrecoverable costs of homeownership.
Sure, the sunk costs.
Right. A homeowner paying $2,500 a month is also throwing money away on mortgage interest, property taxes, homeowners insurance, and maintenance. Those are all sunk costs too, aren't they? Does the math actually justify the jump?
It's a critical pushback, and the answer lies in the mechanics of asset appreciation and loan amortization. You are entirely correct that interest and taxes are unrecoverable costs. However, in a rental scenario, 100% of your payment is unrecoverable.
Yeah, every single penny.
Exactly. In an ownership scenario, the unrecoverable percentage decreases every single month as you move down the amortization schedule. And more importantly, you have to factor in the underlying asset.
Because the property itself isn't static.
Spot on. Think of renting like buying a put option on your local housing market that expires worthless every 30 days. You're paying a monthly premium strictly to avoid the downside risk of a new roof or a market crash.
But by doing so, you're sacrificing 100% of the upside.
Yes. If the asset appreciates, the landlord captures that margin. When you own, even if 50% of your payment goes to interest and taxes initially, you're holding an asset that historically trends upward. It hedges against the very inflation that drives rent prices up.
That options analogy makes perfect sense. You're paying to cap your downside, but you're giving away all the upside leverage. And that really transitions us into the 5 pillars of homeownership outlined in the Elite Credit Group material.
And this goes way beyond the sentimental pride of ownership stuff.
Way beyond. It's about structural financial leverage and systemic control. Let's dig into the first pillar, equity, instead of expense.
This is where we have to talk about leverage, because it is the most powerful wealth-building mechanism available to the middle class. When you buy a property, you might only put down 3, 5, or 10% of the purchase price, but you receive appreciation on 100% of the asset's value.
So if you buy a $400,000 home,
with $20,000 down, and the property appreciates by 5% in a year, you didn't just make 5% on your $20,000. You made $20,000 in equity. You experienced a 100% cash-on-cash return on your initial equity minus the cost of debt.
that is the magic of leverage. You can't walk into a brokerage and ask for a 30-year fixed-rate loan at a relatively low interest rate to buy index funds, but the government practically subsidizes you to do it with real estate.
Which actually ties perfectly into the second and third pillars, stability and tax advantages.
They're deeply intertwined, aren't they?
Very much so. The 30-year fixed-rate mortgage is a financial anomaly unique to the United States, and it is an incredible inflation hedge. Your primary cost of debt service is locked in,
While the cost of labor, materials, and rent just continues to compound annually.
Exactly. Your principal and interest payment stays flat for 3 decades. You are essentially paying off today's asset with tomorrow's depreciated dollars.
And the tax code actively rewards you for taking on that debt. Now, obviously, with recent changes to the standard deduction, fewer people itemize than they used to.
True.
But for many buyers in medium to high cost of living areas, the ability to deduct mortgage interest and state property taxes significantly lowers the effective interest rate of the loan. Plus, there's the capital gains exclusion when you eventually sell your primary residence.
Precisely. You can currently exclude up to $250,000 of capital gains, or $500,000 if married, filing jointly on the sale of a primary residence. Try doing that with your standard brokerage account. It's a massive structural tax shelter.
Which brings us to the fourth pillar, wealth building. The source material notes that a disproportionate amount of household net worth in the U.S. is tied to primary residences.
It's the ultimate forced savings mechanism. Human behavior dictates that if we have excess liquidity, we tend to consume it. A mortgage forces you to systematically build net worth every single month.
It puts you in the game.
Exactly. It ties your personal balance sheet to an asset class that generally outpaces inflation over any rolling 10-year period.
And the fifth pillar is simply control. Yes, this means you can knock down a wall, paint the kitchen matte black, or adopt a giant dog without begging a management company for permission.
The fun stuff.
Right. But from a financial perspective, it means you control your capital allocation. You decide when to realize gains. You decide if you want to leverage the equity for a renovation or an investment property. You hold the reins.
Which culminates in the core philosophy presented in the analysis.
Quote, renting helps you get by. Owning helps you get ahead. It's the classic trade-off between short-term ease and long-term economic positioning.
But we have to address the elephant in the room here. The analysis acknowledges that the vast majority of people already understand this on some level. They want that leverage. They want that control.
But they're sidelined.
They are sidelined, and they usually misdiagnose why they are sidelined.
Here's where it gets really interesting. The analysis by Elite Credit Group argues that the primary barrier keeping people trapped in the renter's cycle isn't actually an income problem, it's a credit problem.
It's a fundamental misunderstanding of the gating mechanisms of the financial system. You can have a strong W-2 income, ample cash flow, and a solid career trajectory. But if your credit profile doesn't align with the algorithmic risk models used by underwriters, you're locked out.
It's completely blocked.
Yeah. The material details a gauntlet of specific hurdles: historical late payments, dormant medical collections, elevated credit utilization ratios, and the cascading effect these have on your FICO scores.
It's essentially an invisible bridge. People think the gap between renting and owning is purely the size of their savings account, but the actual bridge is their credit profile. And because the mechanics of credit scoring are so opaque, people internalize these massive, debilitating myths.
The biggest one being the 20% down payment myth.
Yes. That myth alone sidelines highly qualified buyers for years. They look at a median home price of, say, $400,000, assume they need $80,000 in cash just to enter the market, and they completely give up.
They don't realize that conventional loans often require as little as 3% down, and FHA loans require 3.5%.
But a skeptic would say, sure, you can put 3% down, but then you're stuck paying private mortgage insurance, PMI, which is just another unrecoverable cost.
It is an unrecoverable cost, but you have to measure it against the opportunity cost of waiting. If it takes you 5 years to save the 20% to avoid $150 a month in PMI, and during those 5 years the property appreciates by 20%,
you've essentially stepped over dollars to pick up dimes.
Exactly. You avoided a small monthly fee, but the asset you wanted to buy just became $80,000 more expensive. Optimizing your credit score to secure a lower interest rate and a cheaper PMI premium is mathematically far superior to sitting on the sidelines trying to outsave real estate inflation.
That is a phenomenal point. The cost of waiting usually eclipses the cost of the mortgage insurance. Another massive psychological barrier the material addresses is the timeline fallacy.
Oh, the assumption of, my credit took a hit 3 years ago. I'm at a 620. It's going to take me a decade to fix this.
Right. And this is where understanding the mechanics of credit reporting provides a massive advantage. Elite Credit Group points out that with targeted intervention, the timeline to become mortgage ready is often measured in months, not years.
Months.
Months. That completely reframes the objective.
Because credit scores are just algorithms, and algorithms respond to precise inputs. If you understand how utilization impacts the revolving debt portion of the model, or how specific disputes can force the removal of unverified derogatory marks, you can trigger a rapid rescore.
You aren't just waiting for time to heal the profile.
No, you are actively optimizing the data the algorithm receives.
It's the difference between being a passive victim of your credit report and being an active manager of it. The material emphasizes that as you systematically clear these hurdles, a compounding chain reaction occurs. Your score crosses a threshold, say, from a 640 to a 680.
Suddenly, the interest rate you qualify for drops by half a point.
That drop increases your purchasing power by tens of thousands of dollars. New loan products open up.
And that operational progress completely neutralizes the anxiety. The mystery of the underwriting process disappears. You realize that getting approved for a mortgage isn't about the bank judging your worth as a human being.
It's just about presenting a data profile that fits their risk tolerance. Which brings us to the ultimate questionnaire that the source material uses to challenge its readers. If you are listening to this, ask yourself these 4 operational questions. 1. Do you plan to maintain geographic stability in your current area for at least the next 3 to 5 years?
2. Are you mathematically exhausted by annual rent increases diluting your discretionary income?
3. Is establishing structural, long-term financial leverage a priority for you? And 4, are you willing to actively engineer a credit and savings strategy rather than passively waiting for macroeconomic conditions to magically perfectly align?
Because if the answer to those questions is yes, the data suggests you are likely much closer to executing a purchase than your current assumptions allow you to believe.
The analysis wraps up with a really brilliant reframing. Renting can be a chapter. It doesn't have to be the whole book. Renting serves a distinct, valid purpose during certain phases of your life.
But allowing a temporary mechanism to become your permanent financial reality simply because you haven't optimized your credit profile is a massive, unforced error.
When you optimize your profile, you shift your internal dialogue. You stop asking the passive question, will the market ever let me own?
And you transition to the operational statement, now I understand the mechanics of how to execute.
It's shifting from hoping to engineering.
If we connect this to the bigger picture, it introduces a critical concept about the life cycle of wealth that goes beyond just your working years. Think about the mechanics of retirement.
Okay, let's look at that.
If renting is just meant to be a chapter, consider what happens when you reach the end of the book. In retirement, a paid-off primary residence isn't just shelter. It acts like a highly efficient, inflation-hedged employee.
Because it eliminates your largest monthly cash flow requirements.
Yes. By eliminating your housing expense, that paid-off house drastically reduces the amount of capital you are forced to draw down from your 401k or investment portfolios just to survive. It mitigates your sequence of returns risk.
Wow, that's a huge factor.
So the provocative question is, are you taking the steps to hire and train that financial employee today, or are you going to be forced to pay retail market rent at age 75 because you let the myth of a 20% down payment write your ending for you?
That is the real cost of sitting on the sidelines. It's not just about today's equity. It's about securing your future cash flow. Take control of the algorithm, leverage the mechanics, and start writing your next chapter. Thanks for joining us on this deep dive. We'll catch you next time.
Hey, to whoever may need this nugget of encouragement, things will be alright, so quit your worrying. I get it, the odds seem stacked back against the wall, but even consider it such, know you'll stand tall. Sat and watch from the sidelines one too many times. Wicked games to play make me wanna lose my mind. Found solitude knowing it'll be over soon. Ever need a boost, count on me for the 1-2. Trouble don't last when the tough get going. Baby, all we do is win, so show me my opponent. Adversity, doubt, stress, could care less, cause how we handle those like an S on our chest. Super proud of how we held it down on the way up. Can't wait for our day to ball, this is a layup. Nobody ever said this would be easy, but trust when I say that you got it.